one-layer Mauritius, it will now become two-layer Mauritius, primarily from a exit standpoint. This again, it has to be tested, tempered with GAR, etc. Like, why will you have? Like, if you have one Mauritius holding one more Mauritius which holds all other assets, probably you can justify it from a GAR standpoint, little better, compared to having one hold coin Mauritius for each Indian investment. That becomes difficult to justify, like what is the relevance of having a Mauritius intermediary? It looks primarily from a tax avoidance. The other cases which are put is Mauritius holds Singapore, Singapore in turn holds India. Here Mauritius is selling shares of a Singapore company. Taxable, not taxable. Which treaty will apply? India Mauritius, not India Singapore. India Mauritius treaty I will apply. Again I will see where what shares are getting transferred. They are not shares of an Indian company. Continues to remain exempt as that of the middle case. But while we are advising, we tend to advise just go for Singapore, Singapore or Mauritius, Mauritius. Don't go to mix and match of treaties. So which this is the change under the recent treaty amendment from June it has taken effect, 2016. So broadly, I'll just cover in a minute. If you bought shares before 2017 March 31st, they are grandfathered, which essentially means subject to having that basic TRC, etc., irrespective of when you sell, the capital gains remain exempt. However, if you have acquired the shares after 2017, then your capital gains exemption falls away. They have given only one concession is if you have acquired after 17, sold before 31st March 19, that is if your holding period is 2 years or less, then you apply 50% of the rate, which is effectively 40% half, that is 20% tax. But if you acquired after April and sold after April 17 and sold after April 19, you need to pay full rate of tax in India. That could be 10 or 40% as a case. Clear? Similar change has been done in Cyprus as well as Singapore treaty. Only key difference is that 50% concessional rate is not applicable under the Cyprus treaty. It's there in Singapore. Now there are a few practical aspects here to discuss. One is if I have been holding CCD which have been acquired prior to 31st March 17, but I am getting fresh, I am converting it after 31st March 17 or April 17. Now the question is, will those shares which have been allotted on conversion of CCD be entitled for the treaty exemption or not? Our view has been it is difficult because it says shares acquired after, they do not say shares whose period of holding goes back. Because there has been this amendment for this, CCPS also they have amended this year. So our view is it should not, likewise bonus for example, if you are allotted after 31st March 17, they will also not be entitled for this exemption. So we do a lot of work for this PE funds, etc. Everywhere they are pushing left, right, center bonus issues before this so that the value per share comes down eventually when they go for an IPO, etc. All the shares are grandfathered from a treaty perspective. But while they have done all these amendments, what has been left out is transfer of only equity shares, transfer of shares are covered under the tax net, that is equity preference. If you are transferring debentures, that is outside of the tax net even now. So already we are seeing shift towards CCD from a CCPS, so that you will get the benefit of the treaty even irrespective of when you are acquired. So again they have to do one more round of negotiation and plug it or probably cover it under CAR. Next is slum sale. Broadly, what are the aspects that are relevant here is it has to be transfer of business as a whole for a lump sum consideration on a going concern basis. These are the three conditions that are there. It has to be an undertaking as whole, which constitutes a particular business activity, and the consideration has to be lump sum. So if this is done, next is you need to see whether it's long term, short term. Whether if you have held for more than 36 months, it becomes long term. If it is shorter or less than 36 months, it becomes short term. So that gets taxed at 20 or 30% as a case may be. Clear?
But some of the estates may have been for a period less than 3 years.
See, recently we were looking at a case where some business was started, factory was started in 2000, early 2000s. So they have shed the existing factory and moved everything to a new factory which is only 2 years old. But what I am selling is a business that has been in existence since 2000. But the question was whether it will be long term or short term. Our view was it will be constituted as long term because when you started, It was from 2000, the same thing has been continuing. Just because you have got the new factory built in, which is you're selling as part of it, doesn't make the business as short term. Same example or similar example, I've got two factories, one factory 5 years old, second factory 1 year old, I'm selling them together. Both are in the same business, long term, short term. So your answer from our perspective would be long term. Same thing, if you are breaking up, saying for factory A I'm paying you 100, factory B I'm paying you 80, then one part becomes short term, one part becomes long term, because I've broken the consideration into two bits. Now, how do you compute tax net worth? Fairly simple. Any profit you see, it is essentially the consideration minus the cost of it. In case of cost, because it is business, a combination of asset liability, you need to take net worth. This net worth, I've just defined it as tax net worth. Reason being, how do you compute the net worth for this purposes? I need to take tax WDV of all depreciable assets. I need to add book value of all other assets excluding revaluation that has been undertaken. Minus all liabilities I get the net worth. This compared with the consideration, the delta is going to be regarded as capital. Depending on the period, it gets taxed at 20 or 30% as a case. So next is it okay? Am I covering what is necessary? Okay. So next is purchase price allocation. This is a bit critical. So when a buyer has paid, like say 100 crore for acquiring a business, in the books as well as books of financial accounts as well as tax books, can I show one line item saying I have bought business of 100, or do I need to break it up? Very logical, I need to break it up amongst all the assets that I have acquired. How do you break it up? We call it something called as a purchase price allocation. If I have paid 100, first I'll allocate it amongst all the tangible assets that are there. Then whatever cannot be allocated to tangible assets becomes allocable to intangible assets. Here again I break it up as identified intangible assets, which is the know-how, patent, trademark, copyright, license, franchising, similar asset of this form. Anything that I cannot allocate it specifically to identified assets, then I put it in unidentifiable intangible, which is goodwill. Now again there has been this UB decision etc., where they have said that accounting adjustment or accounting balancing figure of goodwill does not make it as a commercial asset which is liable or entitled to depreciation. So wherever you are doing this, though invariably goodwill will be a balancing figure, we need to be careful to allocate or say that it is comprised of certain commercial rights, therefore it is goodwill and depreciable. Otherwise, you will end up losing depreciation on this particular goodwill if they say that it is an accounting entry and just a balancing figure. So from a VAT standpoint, no VAT is payable on slump sale because sale of business on a going concern basis is not regarded as goods. Stamp duty depends from state to state. Broadly, if you are doing a slump sale, I can say you will end up paying stamp duty only on immovable. Then certain intangibles which require an assignment deed, which are like patent, trademark, copyright, etc. Because you need to go to the respective registry to have them transferred. On this you need to pay. Other would be an actionable claims, because under Transfer of Property Act you cannot assign the debt without paying the stamp duty. So instead of doing an assignment, you can go through the novation route, so where you end up mitigating stamp duty. But for immovable and intangible, pretty much you can carry out a slump sale or close a slump sale without paying any stamp duty, because all assets which are capable of being transferred by delivery, which you will simply transfer by way of a delivery, paperwork and law or the language has to be very critical, because it changes from state to state. Like in Maharashtra, you can say that on the closing date, I executed today, I'll close the transaction in a month. I can say all movable assets are transferred by delivery. Maharashtra does not levy stamp duty on that. In Karnataka, I say that if I say that all the movable assets would be transferred by way of a delivery, they will catch you to pay 3% stamp duty upfront, saying that you have agreed to transfer by way of delivery. How do we end up generally doing? In the agreement, we would have written that this will be transferred by way of executing conveyance deed, whatever is required, all agreements. But in reality, you end up transferring by way of a delivery to mitigate this 3%. Because in Karnataka, the gap is 20,000 and 3% of the value of the assets. In Maharashtra, for example, you can do it with 200 bucks and close a slump sale. Here, at least it's 0.1%. So it is nuanced and depends from state to state. But a lot of planning available under this intangibles. Sorry, from stamp duty perspective. There are certain examples which we will probably skip through. Next is itemized sale or asset sale. So any transaction other than slump sale will qualify as itemized or asset sale. Very simple from a capital gain standpoint. If it is depreciable asset, all gains depending on the block computation will remain short term. If the asset is not depreciable, then it becomes long term or short term depending on the period of holding. Now typically what is a business asset and not depreciable, I can think of only land nowadays, and that would attract the period of holding for that is 2 years now post April as per the budget. So block I've just put VAT is payable on all movables including intangible. Here you need to be careful. This is one of the key factors which distinguishes doing an asset sale versus a slump sale. So stamp duty again similar to this thing. Now if you look at asset sale versus slump sale, here there is some perspective to it. Which one will you do as a seller? VAT is one critical change or difference between the two. Also the capital gains rate that will be there. But typically what happens is in case of slump sale, I end up paying tax upfront. But if I am someone like having thousands of crores of assets and doing one small deal or even 25% of the assets if I am transferring by way of an asset deal, what essentially happens is the consideration I'll reduce from my block. So long as a block continues to exist, I don't need to pay tax upfront, but I'm going to suffer for it through a lower depreciation over a period of time. Am I clear what I'm trying to say? If vis-a-vis if I do a slump sale, like with an example, like say 100 rupee asset, I've sold at 250. If it is slump sale, I need to pay tax at 150 upfront in the year of sale. If I do it as an asset deal, I'll reduce 250 from my block of say 1000. I'll continue to claim depreciation on 750 where I don't need to pay tax upfront, but I'm going to suffer for it over a period of time. So there is this Mahindra case where the department has tried to reclassify a slump sale as an asset sale back as a slump sale to collect the tax upfront. Whereas the challenge that we have normally seen is they will try to qualify a slump sale as an asset sale and collect higher amount of taxes. So it depends from case to case. So many of the cases where a large company is selling, we have converted the deal from a slump sale to asset sale primarily for deferring of the taxes. There's one critical aspect that is important here. Next is we'll move on to merger, demerger. Probably I've got another 10-15 minutes. We'll wind up. 1 hour I'm taking from the time assigned. So next is merger, demerger. So in case of merger, the key change from that of a slump sale or an asset deal or a share transfer is that the company that is getting merged will essentially vanish or cease to exist, and consideration would be discharged by the transferee entity or the amalgamated entity to the shareholders of the merged or the transferor company. Clear? Fairly simple. Now here in terms of process, it takes a bit longer, like about 4 to 6 months, and this NCLT has now come into force after December 15th, 2016. But the problem is initially they are not too efficient in terms of disposing the petitions, etc., because it is still early days that is there. So now we are expecting it may take like 6-7 months, but once NCLT is up and running in full force, probably a 3 or a 4 month timeline should look good from a closure standpoint. So the advantage of a merger compared to any other thing is this becomes tax free from the transaction perspective as such. But if the shareholder gets some shares and which he onward sells, that he needs to pay tax, because tax you cannot per se evade or avoid. Sooner or later it has to be paid. But at least a transaction can be done without taxes. So therefore, typically what happens is within the group you'll end up seeing a lot of mergers, though may not be from a third party standpoint. Because if you've got a subsidiary which has accumulated a lot of cash and profit making, etc. One is I can pay dividend distribution tax on all the cash that has got accumulated at 20%. Other way of bringing up the money would be simply take the company and merge. When you merge, all the cash will end up going upstream, on which you don't need to pay dividend distribution tax. Also merger typically we end up using where, like say, one company in the structure, like say holdco is loss making, subsidiaries profit making, or other way around, you end up merging one with other so that you get an offset of one loss against the other profit that is there. So, and also other things could be like if there are a lot of intercompany transactions, there will be a lot of VAT leakage, service tax leakage, if credits are not available. Also, it's a working capital arc, like if a parent renders service to subsidiary, again there will be service tax upfront. And if it is in trading business, etc., it would be a cost. So, one is to simplify the group structure, you will end up doing merger within the group. Again, more cash, tax optimization, reduction in intercompany transactions, etc. Process-wise, fairly simple. You just need to get approval of the shareholder, creditor. Then you need to go to the National Company Law Tribunal. And then the tribunal will issue a notice to ROC, RD, that is a regional director, and the official liquidator, in case having jurisdiction of the company that is getting killed or merged as part of the amalgamation. And after this, they will submit their NOC back to the court tribunal now, whether there are any past histories, etc. And depending on the state that you are in, OL will also appoint a chartered accountant as an auditor to look at the books of the merging entity or the transferor company. Basis is the merger will take effect. Okay? And we have got this concept of appointed date and effective date. So every scheme will have an appointed date. So the example here could be like, say if I put the appointed date as 1/4/16, 1st April 16, I am filing the scheme today with the tribunal. So I get the approval by June, July of 2017. It comes into effect from June, July 2017, but it takes or comes into operation from 1st of April 2016. So which means from 16, all the companies would be regarded as one single entity. Profits of one can be offset against the other with effect from 16. Also, there is no provision under the law as to how much far behind you can go. Now, we have filed a couple of schemes where we are going with appointed date of 2015 because the company is not complying with 72A conditions for carry forward of loss upon merger, but it has incurred loss in the financial year 15-16. So, we want to get the benefit of that, so that we are trying to get out of 72A by having an earlier appointed date. The longest that we have gone back into in terms of appointed date, we have done a scheme with 3 years of prior appointed date. So you do the merger, then you go back each year, you revise the return, claim a refund. So also even if the revised return timelines have lapsed, there is tribunal decisions, etc., which says that to give effect to a court order, even if the limit for revising the return has lapsed, still you need to give effect to it. So we've got all these things done where you've got substantial amounts of refund. Under GAR again, you need to wait and see whether these things would be challenged. Because initially what used to happen is income tax was not a party to the mergers. You could have done any sort of mergers, they would wake up during the assessment time, by then it would have been too late. Now, almost a year and a half before, they essentially told that the RD should give a notice to the income tax department. If they have any objection, they have to come and essentially represent before the court. Few cases we have seen them coming and protesting or pushing back, etc. But generally it's been smooth this thing. And also unfortunately it is not a positive consent, a negative consent also is good enough. What do I mean by negative consent is so long as they do not come back also you're good. If they come back with a positive, very good. If they come back with saying that this should not be done, then it will drag on. Or if they're not coming back for whatever reason, that is also a good situation to have.
Or consent from the transferring entities from tax authorities?
No, sir. Nothing.
Rate of such disputed liabilities of transferring.
Because in the scheme, what we say is whatever disputed liabilities are will be taken over by this company and dealt with accordingly. So whatever assessments were there will all continue here. If there was a demand notice that was there, will continue. So if it is a third party deal, then essentially you will be worried about 281 issue, or whether that asset itself will end up losing. Within the group, etc., many of the cases we have seen, and even if they come back in the court, we have always said that refer to para so. All pending matters will continue, nothing will stand abated, and it will continue as such. Okay. From a definition perspective, fairly simple. 75% of shareholders should be allotted shares, etc. Not going to spend too much time on what is very obvious. From a tax perspective, from a company's perspective, everything is exempt. Cost of the previous company becomes the cost of the new company. Period of holding also goes back. Likewise, from a shareholder perspective, again the same. Period of holding goes back, cost also goes back. Only new aspect, which is a new development of sorts in the last 3 odd years, is goodwill arising on amalgamation. So this particular thing, earlier it used to be a sunk cost, like more like an accounting adjustment that used to come and get netted off, etc. But post this Smith Securities decision, it has been held to be depreciable. Wherever possible, we end up creating goodwill so that you can claim depreciation on that. Now, the problem that has arisen is after this Ind AS has come into force, earlier we could have done a lot of within the group mergers and created goodwill. Now, after Ind AS has come into force, you cannot do any within the group mergers and create goodwill because pooling method has to be compulsorily applied. And once you apply pooling method, any difference that is there has to be adjusted in the reserves and you cannot take it into goodwill. So the flexibility that was there around this creation of goodwill and depreciation of it, to some extent has been taken away under the Ind AS framework. It's not like a tax initiative, but unfortunately it is what it is and you have to live with it. It's all fine. So again, moving on from merger to demerger, pretty much process, everything remains the same. Only change is that in case of demerger, the company continues to exist and the shareholders of the company end up getting the consideration. So nothing else changes. Process wise very similar, tax wise very similar. So it's not that critical. Only other aspects to worry here is that whatever business you are demerging should constitute an undertaking. Now, few of the cases what we got is I've just demerged one single investment as part of the demerger. Can that be constituted as undertaking? So this problem is there. Answer is yes or no, depends who you are. Like Reliance takes a view that it is undertaking. They've done that Reliance Infocom on this thing. Generally, we are little reserved on this matter because if it is one investment, it can't be constituted as an undertaking because it's just an investment. But if you've got like a bunch of investments which can be constituted as treasury function, that probably you could do it. Okay. A lot of slides I have put which we can go through later. Last 5 minutes I'll wind up. So generally, like if an Indian company is acquired by a foreign company or sought to be acquired by a foreign company, how do you do? Let's say asset deal is not an option. Now you want to get the benefit of the upside, that is claim depreciation, create goodwill, claim depreciation, and also get a deduction towards the interest cost that you have basically built into the structure. How do you go about? Typically what ends up happening is a foreign company sets up an acquisition company in India. I'll keep aside CIC and NBFC issues aside for the time being. That particular Indian company will have some basic operations, etc., so that you don't qualify as a holding company which requires an FIPB approval. All the money would be put or infused into this India holdco, which will acquire shares in the target. Now the structure you got is you got a foreign holdco which has put debt into India and equity into India, or shell company of sorts or minimally operating company that acquires shares in the target. Post acquisition, the target merges up into the acquisition company, or it can also happen other way around. Now by doing this, what effectively happens is the difference between the book value at fair value terms, whatever you acquired, and the consideration paid for the shares becomes recognized as goodwill. Once it is goodwill, it would be depreciable from a tax standpoint. And also any debt that you are infused into the India holdco in the structure will be offset against the operating income of the target company post-merger. So effectively you are getting interest break on acquisition as well as step up of sorts, because the goodwill that you end up creating or recognizing, that becomes depreciable. So in effect, doing a share deal, you are giving the effect of a business acquisition, which these two were the two twin important factors for a asset deal or a slum sale for that matter. Next, this very small thing, nothing so critical in this, but it's just that presence of mind. Recently, we were working on a particular transaction where they had allotted some bonus in the last year, but the entire company was getting sold. Unfortunately, what was happening was most of the shares were long term. Only this bonus was regarded as short term, because for bonus, though the period of holding starts from the date of issue of bonus shares, cost is essentially zero. This was resulting in about 10-12 crore of incremental or additional tax because of that rate difference from 20 to 30. So we were wondering what to do. What we ended up doing was, whatever shares were short term, that is the bonus share, we carried out a buyback. So when you do a buyback, irrespective of whether the shares were long term, short term, the rate is only 20%. So effectively on a short term capital gain, we did a buyback, took out some 30-40 crores out of the company by doing a buyback and paid 20% tax, and the net overall tax saved was about roughly 10 crore rupees. Nothing so great about it, just that when you get stuck with the problem, what are the other ways of getting around? So this, I'll skip through. Other is a cross-border merger. Many companies have set up this way and done also a lot of cross-border mergers. The objective is here is when a structure gets set up, I'll have India company on top. Typically, I'll end up having either Mauritius or BVI. Most of the times, Mauritius would be there. That will have another holding company somewhere, which will have a lot of operating companies. I'll have India, Mauritius, say Mauritius will hold Singapore, and all other companies would be there. The benefit of this form of structure is that whenever cash gets accumulated, I bring all the cash into Mauritius. Okay. If I do that as dividend, I need to pay 15% tax in India. Earlier it used to be 30%. So how you can get around this is, I take the Mauritius company and merge it into India. When I merge the company, Mauritius company into India, I don't need to pay this dividend tax of 15%. Plus such as is roughly about 17%. The benefit of this is I'll end up getting bulk of the money back into India without suffering any incremental taxes. So again, earlier under Companies Act 1956, only inbound mergers were permitted where a foreign company merges into India. Now currently both inbound as well as outbound, both sort of mergers are permitted. But it is still early days because what they've said is this section is not still notified as we speak, the cross-border merger provision. And also they have told that this mergers will be permitted only with companies situated in notified jurisdictions. So more likely than not, you'll not have Mauritius, you'll not have Singapore, you'll have only like US, UK, which kind of take away the flexibility that used to be there. Last slide probably. So here we have got a listed company which has been implemented. Listed company has say two divisions, Division A and Division B. Now we want to list Division B. At the same time, listed company wants to hold certain percentage of shares in the listed company post demerger. Am I clear what I'm trying to say? Generally, if you do a demerger, the entire business would go into a new company, then it becomes a mirror holding. Because if Division B moves into Company B has to allot shares to shareholders of A. And also Company B gets listed as part of the demerger process. So here the trick or the objective here is what we're trying to do is listed company ends up holding some residual stake in the Company B, so that whenever post listing, these shares can be sold on the exchange subject to a period of holding 1 year, and then you can claim exemption under 1038 and not pay tax on this particular income. A few more things, I think we are running short of time. I'd like to conclude here. Thank you.
Thank you, Amithraj, for your crisp and very good presentation. Any questions, we can take offline. May I request Vishal to propose a well-reserved vote of thanks?